you say the word historic, I'm going to back up and I'm going to put a little emphasis on that.
Hi, once again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you, and today it's a special guest with me. I have the founder of Comstock Investments, Mr. David Kruse, and I thought we'd go right to the top here today, David, with all the things going on in the world. And of course, last week was craziness. We're seeing more craziness here to open out this week. We had the tariff announcement, then we had counter tariff threats and back and forth, and now we have everybody wanting to come to the table. Huge swings just this morning. I mean, we're recording this at mid-morning today here on a Monday, and we already had like a 2,400 point swing in the Dow, higher and lower. The grain markets came back early this morning, so it seems like maybe the ag sector is possibly going to divorce itself a little bit from all the craziness over in the equities. What's your take on all this?
Well, there's plenty of things to keep an analyst busy and thinking as it comes into this. But of course, this was all sparked from Independence Day. The tariffs. I think we've got a slide there that shows the average result of the tariffs that were imposed by President Trump, if you can put that up. We went from basically 2% tariffs to 22.5%. That spike back over there in the 1930s was the Smoot-Hawley Tariff Act. And, that has historical significance that it is believed that it maybe worsened and prolonged the Great Depression. I think that probably it wasn't it was by no means a singular reason for that, but it didn't help at the time. And so now we're going to try tariffs again. And you can see there's a pretty healthy historical level of tariffs on the rest of the world. Essentially, we're going to charge the whole world a fee to engage with us in commerce. And we'll see how this ends up with Trump's going to do with a lot of negotiation. There will be a lot of that involved in this. There's some things that are being exempted. I had our monthly phone call with our German friends in Dresden, and the young man there is a CFO for a vaccine company that exports to the United States, and we're their biggest market. And so he was on needles and pins as to what was going to happen with the tariffs, but they got a notice from our Commerce Department that the vaccines that they produce are going to be exempted, and he was ecstatic. Anyway, they ship them here and they do package them here, but he was actually having a relief day, I guess, as a result of that. Well, that can go from sector to sector and from business to business and from person to person as to how this is all going to impact us. And of course, farmers are on the forefront of that. We have been for some time now, I guess, advising our clients to get smaller was the way I described it. I watched what Warren Buffett was doing with fascination as to how he was pre-positioning ahead of this period. And I did many things likewise. And so from even I have a family stock portfolio, and our largest stock became Berkshire Hathaway, like their large cash positions. And we've gotten to the point here where, what do you want to say, there was no place to hide in some of the selling here that we've seen in the last several days. Even Berkshire Hathaway had a sell-off. We've sold off a lot of stock ahead of time, and so we really consolidated down to just these very what we thought were safe havens, and actually went into some precious metals too at that time for some coverage. We had recommended selling all of our cash grain, and we'll get into that a little bit later. But and so we essentially went to a cash position ahead of this. I can't remember the exact day. Maybe it was 2 weeks ago. I did on our report recommend buying September S&P put options, and I spent about $10,000 for a 5,800 strike September put, and I think it was worth 40 some sometime in here in the last recently. It has a lot of time value left, and we'll see. And so by being in just an option, you can participate in this market on the weakness side, and but your risk is limited because it is just a put. It takes a pretty good investment, but gosh, the return looks like it's going to be pretty potentially phenomenal. It's not done until it's in the bank. I wanted to give the overall long-term perspective of the stock market so people can maybe get a little better idea of, we talk about these big losses and the gains and what do they really amount to? Well, this has been a 16-year bull market. The bottom on this chart back in 2008 was at 666. That's a nasty number to start from anyway. You can see that over the course of these 16 years that, the stock market went up 9.2 times its initial where it started. Went to 61.47, 5,800 and some point rally. And so it's been a phenomenal run. This chart actually came from Dave Toth. He is the technical analyst for RJO, which is the firm that we clear through. I have, over the course of my years, watched a lot of technicians, and in my opinion, he is the best. And he kind of outlines the Elliott wave counts, and he had actually been giving us warnings that there was potential here for a major high. You can see that yellow line up there is at about the 48.08 level, or right in there. My eyes aren't just perfect on that, but we essentially hit that overnight on the big break, and so we've hit that first most support level. Well, so we've had this big break. Look at that break on that chart. Barely doesn't amount to much. The real downside risk in this market is far, far, far greater. When I look at, normal 38 or 50% retracements, they are significantly lower than that. First of all, I mentioned this is a 16-year bull market. I think it's 40.65 is the 38, and 27.40 would be the 50% in this. And so you can see with those, a lot of times markets will go back to previous fourth wave levels. And so the next level of support, I think, is down around 34, whatever. And so we'll see. But to give the perspective here that in the big scheme of things, is this a big bear market? Not yet, but it sure could become one. Because of the way it's being driven by, has a very strong fundamental basis for happening. We've just turned the global economy, essentially, that's been in place for about 70 years upside down. And so to expect actually this minor correction, as what I would call it, in this monthly chart for a 16-year-old bull market, I'm still basically a turtle with my head pulled in my shell from that far as far as being willing to go out and put on risk here at this point. We've taken the risk off, and nowhere stretch may want to put it on yet. So I'm going to go to the next chart, and kind of gives us a little better picture of where we are today. This is an hourly chart of the September S&P, and you'll note that there was a gap down at about 5,600, and then what looks to be a precipitous, we call that a third wave decline in technical jargon for Elliott wavers. Last night it opened a gap to the downside. I was concerned this morning that would be a measuring gap. But you can see the market did come up and test it, fell back, but it did later this morning, and all this volatility come up and close that gap. And that's actually it's helpful. It's a good thing. At the same time, that's likely still to be just a minor correction, and still the risk continues to be to the downside. And but at some point in time here, we can get this particular wave bottomed and get a larger correction that should follow that. I think that the volatility is going to be eye-watering, probably, that we see here over the next few months. Every news story that comes out there, like I said, it was off sharply, and then there was a news story that came across that the Trump administration was going to put a 90-day waiver on the tariffs, and I think that's what caused the the rally, and we filled that chart gap, and then the White House denied it and said no and whatever, and so then you come back down. But maybe we've taken some of the edge off it for the day at least. But anyway, this is the short term look at it, and there's still things to be worried about. I go back to probably the most comparative period for something similar to this. I think you go back to 1980. And I happened to live 1980 too. I think you did too, as well, as far as what we did in agriculture. I'm going to have an extensive report on it probably tomorrow on some of the comparisons I see. But what we saw in 1980 was a new administration come in, Ronald Reagan, and we had runaway inflation. And the Federal Reserve, with Paul Volcker, was decided that it was their job to kill inflation. And he went to President Reagan and told him what he was intending to do, and that there could be some political consequences as a result of it. But Reagan said it had to be done. But they wanted to do it very early in his term. They did it right away. And so therefore there was time potentially for a recovery before the 84 election. And that is what happened. I think that we go back to the Great Depression, and unemployment was 20%. In the recession that came as a result of what Volcker did in the 1980s, we ended up at 10% unemployment. Well, and the Fed was able to fix that very painfully. Unfortunately, agriculture was in the worst position possible. We were super over leveraged. And so when 18% interest rates and a $156 index happens and killed our exports, we were vulnerable. The farm banks were dropping off right and left. It was nice that Congress did feel bad for those banks, though, because then they put together the Farm Bill to help save us and therefore save the banks. We were part of the process, I guess. But it is a little different than this particular situation. Is that the inflation was fixable. It was a problem that the Fed knew how to fix. I don't think the Fed knows how to fix this one. Some people were happy because oil prices were going down and interest rates might fall, eventually. But because the economy's tanking, I mean, is that a good thing? Is that why? I guess that'll help maybe buffer it at some point here. But the Fed is really caught between the inflationary impact of these tariffs and a slowing economy. And so there's a lot of expectation that rates will decline, and that and eventually the slowing economy, I guess, is going to win, is what they're saying, and bring those rates down further. But time will tell. There's a lot of potential outcomes, I guess, to this as it goes on. So, but so there's similarities and there's differences. So they're doing this very early in Trump's term. He essentially went and played golf while the stock market was collapsing, and tries to make it as matter of fact as we can, that this is just some pain. There's going to be a lot of gain. Time will tell. There's a very much different situation for agriculture this time than what there was in 1980. In 1980, we were over leveraged to the gills. This time it's not that way. I think most farmers still have pretty solid balance sheets. The farm lenders learned in the 1980s that not to get loaned too much on an acre of land. Interest rates are not high; they're down. The dollar itself is at 102. We hit 156. In the 80s no wonder nobody could buy anything from us. The dollar was so strong. And so there's a lot of these things that are in our factor. The other one is that Donald Trump says he has our back. And I guess I believe him. I got a check just a week ago from the last bailout, I guess, or what? That's not a good term to use. It's not. It was compensation for an incompetent USDA. Was my way I interpreted it, and I can explain that just a little bit. From February of 2024, the USDA had misread demand and overstated supply by 700 million bushels. And they had then displayed a very negative, balance sheet situation that was false. It did not exist, and they corrected it here. They brought that carryover way down from where it was over there. But that's really was, I think, the root cause of the ag recession was that misperception and calculation that they put out here to us. And so we got that corrected, but we got a check for that, I guess, from that standpoint, which I thought was right. They tell us that they're going to have our back for this next round too, and as we get to some losses and stuff, that they will be there for us. So let's look at the next chart on the one on soybeans now.
All righty, let's go ahead and bring that up here. So let's talk soybeans for a little bit.
Yeah, this is the continuation chart on soybeans, and this is from Dave Kruse again from RGO. And, he's been believing that we've been in a long-term bear market. The soybean market sure acts like it. All the characteristics seem to fit that. And to get a bottom to this particular market, we very likely need one more significant wave down. And so that means that 945 August low of last year, at some point in time, was likely to be taken out yet. And the good news, I guess, is that would also likely finish the bear market that we're in here. This year we're, and with the tariffs, we export about 42% of our soybeans. We about 20% of them had been going here to China. I feel that a lot of different countries has actually stocked up, had given themselves some cushion we've seen a really good run here on exports. And I think that was as a result of anticipation that something like that just happened could happen. And so I think they have some inventory. And so China right now is not going to buy anything from us. And that includes pretty much everything: sorghum, hogs, or pork, anything that they had been purchasing, that's just going to shut down completely. The 50-some% total tariff that they have, or even if it's just 34% on some of the items, it makes it all doesn't work. And so we're going to look at again. They're going to make Brazil great with these tariffs. Brazil will then have a challenge this next year of how will it respond to this? Are they going to take the risk and aggressively again expand soybean acres along with some other things like milo and cotton and whatever, because that they're going to have more of a concentrated market from China. The first round of tariffs that we had, that was compensated when China quit buying, in part because other countries, Europe, picked up some of the slack. This time we slapped these tariffs on everybody. And so, I think there's going to be less goodwill toward continuing to buy for us. We're going to be considered to be an unreliable trading partner. These partners, or our trading partners, don't, and for good reason. They don't know what the policy is going to be tomorrow. It changes hourly, almost sometimes, as to what happens. One day something's on, the next day it's off. And somebody says something in the administration that they say didn't connect with someone else, and it's mixed messages all over the place, and it's chaos, and I guess sometimes chaos creates some opportunities. But we had felt for some time that we were going to go into a period of risk here, and so we did, I guess, somewhat aggressively market all of our 2024 old crop. Corn and soybeans were completely sold out or hedged. We do have some basis that's still open on the corn side. On the new crop, we've hedged about 20% of soybeans. I think our hedge price is $10.58, so that'd get us pretty close to $10 cash where we live. The corn, we've got about 30% hedged. We really pushed it on the crop insurance, revenue assurance. We did the 85% level, and then we also went to the ECO. and that can get you up as high as 95% coverage on the crop insurance side. Then I'm also anticipating that I think there's a good chance that we're going to end up with some compensation from tariff compensation for what's happening here. So we're covering ourselves revenue a lot of ways. It's not even inconceivable that where reference prices are set, normally we thought they're too low, they'd never be hit. It's not inconceivable anymore that maybe the reference prices in the Farm Bill could trigger something too. And so at some point this year, what we tend to do right now is we got down to numbers when we felt like there was that our downside risk has been most eliminated. We may go long futures and therefore lock in our crop and revenue insurance indemnity and then collect, hopefully, a payment for Trump tariffs. And we could make good money in soybeans if that happened that way. Right now the corn market's been holding up relatively well to soybeans. The ratio for corn and soybean ratio screams to plant corn, and the market has been working that way. My warning to that would be is that right now there's always, this happens almost every year, but the market traps farmers from the standpoint that it'll give them encouragement to plant, and then when they do, it's over. My concern would be is here's this holding up great. Yeah, wonderful. Boy. But when the weather breaks and the planters start to roll and it looks like the crop's going to go in good, then I think that corn can join soybeans at that point in time. That would be my concern.
What about all the concern, David, about maybe a possible dry summer in the Western Corn Belt and in the plains? Is that panning out or not?
Well, I think at this point in time that there's areas that are significantly dry. I know that I've seen Eric Snodgrass is looking for a 60% chance, I guess, of drought. And we have talked about the 89-year cycle. At sometimes, though, at some point, you start to wonder if the contrary opinion maybe comes in there. Everybody's anticipating at this point in time the chances are high for a drought this year. That can create a market situation that if somehow or another it's not, that's how you get to $8 soybeans.
Some have been asking if, instead of trying to catch a falling knife, if this does present an opportunity where if there is an extended sell-off because the farmers were pretty smart and did marketing ahead of time this last fall and winter, we found that out at our seminars, if that would present an opportunity for them to possibly re-own what they had sold or pick up some call options to replace part of that at much, much, much cheaper prices, maybe if this sell-off does continue. What do you think about that?
I guess I'm focused mostly on new crop on that. I think last year's finished. It's in the books as far as I'm concerned, except for we hedged the last of our corn at about $5 in futures. Our base, we're looking for still some basis improvement. At that time, I think the basis was negative, and now it hasn't. I think it's 15 over now, and I'm thinking that there could be that could go to 30 is my target would be, and so then that would finish off my last cash sales there at that, if that comes true. But I guess I'm going to focus on the new crop, and if we got some surprising price breaks in here, whatever, I am looking at it as opportunity. I went to cash essentially with the old crop, and if a person wanted to speculate on I'm not going to say that at some point this summer, if we see a setup for a drought or dry conditions coming in, that we won't do exactly what you said and re-own some of that old crop. But, I'm going to be, and again, still, I'd be maybe again still more focused on new crop then, because that's what's going to be impacted by it from a drought. And we've got it covered now with our revenue crop insurance. And so what you're essentially doing when you go long is you're locking in an indemnity, at whatever that is. And that's all the indemnity you're going to get if the market continued to go down. So there's still some risk to it. But I guess at that point in time, there might be a point where You could lock in your crop insurance indemnity, and then actually the farm or the reference price picks up from there for downside risk. You know, there's a lot of things here to watch, and I think there's opportunities here. But part of it was starting out. You don't want to get behind the eight ball on this thing, and we were preemptive, and I'm pretty comfortable with where we're at, and we accommodated the possibility that this was going to happen. You know, and so we'll see.
Well, David, it's great to talk with you again. Thank you for sharing your insight in the markets on what is turning out to be kind of a historic timeline here with big moves in the markets.
You say the word historic. I'm going to back up, and I'm going to put a little emphasis on that. I'm going to tell you that on that stock market, in that 16-year bull market, that might be the high for you in my lifetime. At that point, it might be the high for it. Could be a generational high. If I was a younger person, I had a 401k or whatever, if you got a decade to go, and maybe we're both going to live much beyond that, but I think that longer term, the market will eventually come back. But we could be in such a massive adjustment worldwide with, you don't just upend 70 years of a global trade structure and have it over in a week, or 2 weeks or a month or whatever. It's in. And okay, so China, let's move back up here and say Donald Trump just put a 34% tariff on China, along with the 25 he already had. Well, he says that's where it ought to be. China comes back and retaliates at 34. My expectation is that to get to where he thinks it ought to be, he might have to respond again to them and hit them again with another 34. You notice a lot of these countries, if you watch how they responded, some came hard and some have played it low, I guess. By that means, for example, here's Canada got, they came back with strong retaliation. Mexico was quiet. They wanted to work under the scenes. Let's talk about it, negotiate. China hit right away. Europe was all kinds of bluster ahead of them, and then when they happened, they went quiet. And now they want to talk. And Japan is just shocked. They didn't expect they would get any, and the formulas and all this stuff, none of them make any sense. To be honest with you, from a math perspective, it's I guess it reflects what's in the mind of the guy who this is his program. It always has been. And he's now got an opportunity to do it, and he's going to go through with it, is my anticipation. So what we've got to do is survive it, prepare ourselves so that we can protect our equity and look for opportunities. And just like he said he was going to put the tariffs on, he said he was going to take care of the farmers. And we need to hold him to that. So time will tell.
Well, let's see how we're doing maybe in a couple of weeks, and we'll compare notes and see how things are actually coming to fruition by then. Thank you for the time, David. David Kruse, the founder of Comstock Investments, with us here today. Appreciate you joining us on this momentous time in our lives. For producer Breanne Jenkins, I'm Marlin Bohling. We'll catch you next time right here on the Comstock channel. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.